now bring you an exclusive conversation. Lata Venkatesh caught up with KV Kamath, the chairman of the NABFID, on the sidelines of the NABFID Infra Conclave 2024 and discussed all about the ongoing infrastructure project financing. She began by asking about if there is a pickup in infra project financing after what was a lean period.
Yeah, two things have happened. Probably the worst was up to 2015, 2016, and today. For example, the default rates have dropped dramatically. It's now less than 1%. So you have credit-worthy borrowers on the other side of the picture. What was needed was long-term financing for these companies who are coming into the market now, borrowings. So far, banks were meeting there. They did a great job. But there's a natural misfit between a bank financing an infrastructure project and a long-term financial providing. And that is, infrastructure projects by nature are longer. And you have a bank where the average maturity of is 1 year or little over 1 year. So you're carrying a risk which has to be hedged and difficult to hedge. Enter the long-term fund. The long-term fund has a problem. Where is his source of funds? You remember the DFIs of the 90s?
Yes.
That was a problem. They didn't have the long-term. But today, with the development of the pension industry, the insurance industry, and even the mutual fund industry, you have a range of providers of funding to this. And we heard from SEBI that now there is a very active bond market in the country. Yeah, more innovation can be done, but there is already an active bond market. So in a way, NABFID is right in the middle of this. You quoted a number. Now, NABFID's approvals, I think up to the last month or so, put 1.5 lakh crores. And I would expect that to significantly increase, almost double over the next year and a half. Now, our capital is just 25,000 crores. If we take our net worth, maybe 30,000 crores. We have raised 30,000 crores. But to meet even what we already approved, we need another 90,000 crores, which will come from the capital market. So we are going to be there in bigger and bigger measure over the next 6 months to a year. And as our book builds, the approval book builds, we will be coming into the debt market even more to a more significant amount, so that we can meet the needs.
I will come to NABFID's own activities in just a minute. I still want to measure the ecosystem and its interest. For the first, your CEO Rajkiran Rai presented that for the first time we have a large amount of patient capital. If you look at insurance kitty plus pension funds, he pointed out it is 115 lakh crore. Bank deposits is about 210 lakh crore. And infrastructure and pension is growing at 20% nearly, whereas deposits are growing at 11%. So the catch-up will come. Do you see this insurance and pension fund taking interest in infrastructure? Because insurance by its very nature is less risk-prone.
Yeah, see, the idea was that if you can sit with these providers of funding and explain to them the risk profile of the assets that you are financing, then they are satisfied. But imagine that this sitting was happening 15 years back, where you have a very nascent infrastructure industry. It was not private or not public-private, it was still government, so not market tested. Then you have private companies come and market test, and there's a problem, the stranded assets of 2014. And why did that happen? Because a whole lot of problems which you had not anticipated hit you. Acquisition, environmental clearances, and so on, and delays and so on and so forth. All those have now been addressed, as a result of which what was peaked in probably 2016 at 5 or 6%, we're now talking of a little over 1%. Now when I think the patient capital, the owner of patient capital, or where it is resting today, looks at this, he looks at this as a good way to invest. He gets a higher rate of interest than a government security would provide him. And it is, he understands the risk that is there inherent in this. He is willing to put the money.
Do you think banks will move into infrastructure like they did, when you were at the helm of ICICI, the 2000 to 2010 period? The percentage of the bank's book in infrastructure was significant at that time. In corporate itself, it was significant. Now, 60% is retail for a bank book. Do you see them coming back or overcoming the blues of the previous decade?
2-3 things need to be seen. One is, what is the ideal asset mix for a bank? They are at a 1 year end of thing, shorter loans, whether it is typically short cycle working capital loans or retail loans, which
Yes.
are typically resettable loans, are probably the ideal product.
Asset liability for match for them.
Then you need to probably round up your portfolio and have 15-20% in other assets which can be hedged. Again, you don't want to go 10 years, 15 years, not 15 years, but even 8 to 10 years
Yes.
with 1 year liability on your, or 1 year assets on your side, and take 1 year liabilities on your side and take a risk. So you will then run a balanced book, of which a small proportion will be term loans, either to industry, SME, or for infrastructure. So incrementally, the funding for long-term infrastructure projects will have to come from markets, and wherein the markets get it is from this patient capital that is lying
It's from
there,
insurance.
with intermediaries like NABFID providing the initial approach, and then maybe the ecosystem gets built up as we go along.